Hello, good afternoon or good evening, and welcome to the next session of Pivot 2021, which is project finance, business models, financial incentives, financial instruments and incentives. My name is Tim Lyons, I'm the moderator for this session. And a bit about me, I've been in the energy industry for about 40 years and worked in about 40 countries. At the moment, my main purpose is structuring and raising deal finance, both in the oil and gas sector and the geothermal sector. But I'm also involved in asset valuation, resource reporting and engineering. And I'm a director of a firm called Oilfield International and also Black Bear Energy, which is an oil company. I trained as a petroleum engineer at British Gas. And in a parallel career, I led the European Commission's development of district heat policy and legislation for the 13 Central and Eastern European countries back in the late 1990s, when those countries were joining the European Union. And I was also the energy policy advisor to Romania in the early 90s for the European Commission. And my role covered electricity, district heat, coal, and energy efficiency. And I'm a past chair of the Society of Petroleum Engineers Distinguished Lecturers Committee. And currently, I represent the SPE in its geothermal and its data science initiatives. So a little bit about this session. I just want some broad remarks is that mining for water, very similar to mining for oil and gas, with one exception, which is that it's not worth so much, possibly only a tenth. And therefore, projects tend to have much lower internal rates of return or much higher capital costs to get to the same rates of return. But they have similar subsurface risks. With some of the technologies, many of the risks are the same: permeability, subsurface porosity, fracturing, etc. And this causes a problem because if you look at the duty of private equity and public equity, it's to maximize return on equity for a given level of risk. And indeed, that's often referred to as the efficient frontier of return. So for a given level of risk, how do you maximize your rate of return? And in that respect, geothermal is generally not competitive. And therein lies the challenge, or one of the challenges we're going to try and face today. And the way I articulate this as a general remark is, how do you de-risk the geothermal project lifecycle? And why is that important? It's because if you think again of the equity, it's looking to maximize its return for a given level of risk. And therefore, if you lower the risk to equity, then they can accept lower returns. And a similar thing applies to the debt. And we've got a couple of debt specialists on our panel tonight. So in essence, what I'm hoping this session will do is see how best we can satisfy the debt and the equity, which will be the principal providers of large-scale finance for geothermal in the future. So the objective of this session is to try and share geothermal finance experience from around the world. And within that sharing, to discuss what initiatives have worked, what financing ideas have worked and generated profitable returns or sustainable returns. And also to try and understand what gets in the way. What is it that means, so far as equity and debt are concerned, that they're not interested in a wholesale commitment to geothermal energy, whether it's power or district heating. And then what can each actor do to help the process? And to give you an example, you've got multilaterals and government offices. There are various things they can do to incentivize or ease the way for private sector equity and debt to get involved. And the private sector itself can both use the techniques that are already familiar to it, both in the oil and gas sector and other sectors, but also look to how it can innovate specifically to de-risk some of the life cycle in order to make these things more financeable and more attractive at scale. So that's in essence what we're going to try and do in the next hour. And what I'd like to do now is in turn give our four guests a chance to give them a brief introduction, and then I'll talk to you about the next stage. So first of all, I'd be delighted, Elin Hasgrim-Dottir, to provide a brief introduction to yourself and what it is you do at the World Bank.
Yeah, hello. Thank you, Tim. My name is Elin Hallgrímsdóttir, and I'm a senior energy specialist at the World Bank. I work in a global unit called Energy Sector Management Assistance Program, or ESMAP, where I lead two geothermal programs. One is focusing on geothermal electricity and one on geothermal direct use. My background is mechanical engineering, and prior to joining the World Bank, I worked as a geothermal consultant for more than 20 years. So I think that is a brief introduction to me.
Excellent, yes. And of course you're an engineer, so you know.
Yeah.
Okay, so next perhaps Ivan Das from Raverbank in the Netherlands. You'd like to say a few words.
Hi Tim, thank you. Thank you for having me over. I'm Ivan Das. I work at the Raverbank for over 25 years now. And the last 12 years, I'm at the project finance department, and I'm mainly involved in renewable energy financing. And the techniques I cover are, the bulk is solar. It's really hot now in our country and nearby, of course. But also biomass conversion, various biomass conversion techniques. And of course, last but not least, geothermal energy. Whereas in the Netherlands, until now, we only have direct use projects. So quite different from the most of the rest of the world. And
by direct use, you mean what, district heating for industry or residential purposes?
That's right. Yeah. This district heating until now, mainly for greenhouses. So in the horticultural sector, we are now progressing towards district city heating, but that is not much easier than the conventional district heating in the horticultural sector, because of a lot more stakeholders and some challenges on the permitting side.
No kidding. Yeah. Okay. Fascinating. Okay.
Sorry to say so.
Okay. Katie Truer from Goldman Sachs. A few words from you.
Hi, Tim. Thanks for having me here today. My name is Katie Truer. I am a vice president in Goldman Sachs' investment banking division. I work in a group called Project Finance, Infrastructure, and Principal. We cover project finance in both the U.S. and Latin America. Very active in power, renewable, transportation infrastructure, and everything project finance. So very happy to be here.
Cracking. Very good. Very interesting. Yeah. And you said South America as well as USA.
Yeah, so US. Yes, US and Latin America.
Very interesting to compare and contrast those in due course. Okay. And Julian Richardson from Corrosion Insurance, the last but not least.
Hi, Tim. Hi, everybody. Pleasure to be here. Yeah, I'm the insurance guy. We are a boutique insurance business focused on how we can use insurance capital to de-risk investments into sustainable and climate compatible development. We've been working on geothermal for well over 10 years, and we developed a solution to underwrite resource development risk to complement debt and equity. Insurance is an important part of the capital structure, and I look forward to telling you a little bit more about that. I am actually someone who's already pivoted from the oil and gas sector. I spent my first 15 years in the insurance industry, insuring oil and gas companies, and now I work on the other side of the energy and environmental spectrum.
So you've gone to the light side, I suppose, is what they'd say.
Indeed.
Okay. All right. Okay. Thank you. Thank you very much, Julian. Thank you all. Okay. So the way I would like to structure this part of the conversation, other than as I've already told you that effectively you're at my place and we've just had dinner, is to allow you to introduce yourselves, or rather your experience, and I'll give you each one of you a fairly open-ended question, which you can interpret any way you like. But as is normal in a dinner conversation, then yes, by all means, be on your soapbox for a few minutes, but expect others to pitch in and have a little debate or an argument with what you have to say, or share their own experiences. So try and make it as much a natural conversation as possible. So I'd like to start with you, Elin, the World Bank. And the question is, what has the World Bank done to enable and incentivize geothermal power and heat production? And how successful was it?
Yeah, thank you, Tim. Maybe I would like to start by saying that multilateral development banks provide one channel for delivering public finance support in low to middle income countries. And financing is primarily made available in the forms of grant and loans below market interest rates.
Did you just say low to middling countries? You mean in income?
Yeah, low to middle income countries.
All right, so you're not interested in North America and no, okay.
No, I mean the World Bank and most of the multilateral development banks are focusing on low to middle income countries when they are providing, because they provide fundings in grants and loans, as I said, below market interest rates.
Right.
But there are plenty of countries within that have geothermal resources, like Africa, Latin America, Indonesia. So, there are Turkey, for example. So there are, which are in this low and middle income rate. Yeah. But maybe regarding the enabling, then in 2013, ESMAP launched a global geothermal development plan to shift the support from downstream to upstream geothermal development. And in 2015, the GTDP, as it's called, had raised $235 million through clean technology financing, and which leveraged further $1 billion in World Bank lending. This resulted in that the Multilateral Development Bank in the geothermal sector financing for upstream geothermal development increased from 6% from 1975 to 2012 to 39% in the year 2013 to 2020.
Sorry, Elaine, did you say that the $230 million, is that grant funding then?
Yes.
Okay, which is why then you can get a lot of debt behind it. Okay.
Yeah.
Right. Okay.
But this was, these are projects that are already in operation today or are on their final steps. So as a result from this, we have established 240 megawatts online, and we have a further pipeline of 600 megawatts, hopefully in Indonesia, as a result of this leveraging of money.
Okay.
Yeah.
No, I was going to say, and who owns that project? Is it the government of Indonesia or is it private sector? How does that work?
So like in Indonesia, they have been establishing this risk mitigation facility, or GREM, I think it's called, where the government will support both private and public entities with risk sharing. So they loan money to the project, but if the resource development or if the resource exploration drilling does not succeed, and there you need to come to a conclusion what is success, then part of the funding will become grant. So they share part of the risk, and there is a difference if it's a private or is it a public. We also have a risk sharing mechanism in Turkey where only private companies can apply, where it is the same similar setup, is that you agree on a set of what is a success, and if the resource is not as was expected, then part of the loans become a grant.
Sounds like an insurance product.
I mean, it is. Of course, it is. It's a risk sharing. So it does the same thing, except it focuses only on specific amount, and it's not always. It's usually 40% or of the initial cost. There is also in Africa. There is also a GRMF. It's called Geothermal Mitigation Risk Facility, where both, I think, public and private companies can apply. There it is only grant. You can have grant up to a certain amount. It is not related at all to the success. So there are out there there are several facilities available to de-risk, so to say. Some are larger and where private and public entities can come into, but there are then other like projects within multilateral development banks that focusing on a single project, where it is not like these facilities where you can have multiple projects applying for this risk sharing. So there is this two kind that the bank has been involved in.
To put it politely, are your clients capable of all the various, I don't know, requirements or steps to take to get to the stage where a project like this is financeable and can be approved by the World Bank or any other bank for that matter? So, you know, the technical work, and presumably there's some sort of an agreement to buy the power, all those things. How does, can you help with that? What's the...
So, I mean, big portion of what the bank does is capacity building, and assist them in building up these, either hire somebody that knows what is needed to be done, or build up the capacity within them, within these facilities.
I have to say, I remember that when I was at the European Commission, we all used that word capacity building. It took me a good 3 or 4 months to understand what the heck it would look. What do you mean? You mean making people more capable than they were, yeah?
Yeah, I mean, it is, you know, learn by doing, or teaching them, or, you know, assisting them in education, and or assisting them in hire somebody that can do, as I said, what is needed to be done.
Fascinating. Anyone else want to pitch in? I'm hogging the conversation.
I'll chip in, Tim, if I may. You know, the scheme that was set up in Turkey actually came from some of the original work that Julian did on behalf of the World Bank and the IFC, looking at the risk barriers to geothermal production and moving those projects forward. So we came up with this concept of a sort of resource risk guarantee that was adopted in Turkey, and that now we are mobilizing out to the, you know, through the private sector insurance industry and more broadly across the world. So, you know, from our point of view, we're sort of geographically agnostic, but geologically specific. So we can work in many different countries, developed and emerging economies, and take those risks. And I think the point you make about the capacity building, Ellen, is really important. And Tim, to point that out, Ellen referenced the GRMF in East Africa, which is a geothermal risk mitigation facility. And like many facilities, it's had some successes and it's had some criticisms. But one of the things it has done really well, it has implemented a certain rigor in the project development process and enabled projects to, or you know, sort of force them to follow a well-defined process, bringing in all the expertise necessary to develop good geothermal projects. You know, the resource is one thing, but the way it's developed is quite another. And having that expertise is really important, and it's something that is often lacking in some of the projects we look at. We do wonder, do the projects have the capability to see it through to the end? Do they have the technical expertise and understanding? And it's not sufficient just to say, well, we'll buy in the expertise, because you also have to be an informed buyer. It's not good enough to simply think you can buy it all in.
Yeah, very interesting. Yeah. Okay, so I think, I mean, we can carry on that, but let's try and broaden the conversation a bit. So I want to bring in Raverbank, so Ivan, and I'm aware that Raverbank's been involved in this for at least 20 years. So why don't you tell us some of the experiences you've had, Ivan, or indeed corporately you've had about 20 years of lending to geothermal district heating projects?
Hi, thank you, Tim. Well, our experiences are, in fact, thanks to oil and gas, because Shell and Exxon have drilled a lot of wells, thousands of wells in our very small country. And that is why we have quite some good data about the subsurface. And that makes that, since this data is until a large extent also publicly available has an effect that we have quite some wells drilled just for geothermal energy. And because our government sponsors the extra cost of the renewable energy above, in our country it's mostly natural gas, there's a quite stable subsidy incentive for the development of this direct use projects in our country. And what we have learned is that whereas at first, in the beginning, a lot of people advised us that because everything goes well in Paris and in Munich, everything will also go well in the Netherlands. But now, about 20 years later, maybe 15 just, we experience that our country is in a delta. So some rivers building all kind of sediments, which makes that our water and also the water quality is quite different from the water in the Paris Basin, and also quite different from the water in, let's say, the Rheingraben and other areas. And that leads, unfortunately, to quite some challenges at this moment, because in the first years, we ordered casing, and we put a casing until about over 3 kilometers depth. And now a lot of these casings appear to be not of sufficient quality. So there's a lot of working over going on in our country, mainly for GRE, so composite casings, inner tubes, to keep these wells intact.
Okay, so you're getting massive corrosion of the of your steel tubing.
Yeah, it differs from area to area.
Yeah,
but indeed, corrosion is really an issue at the moment. Yeah.
Okay, what's the temperature of the water at the bottom of the resource, roughly?
It varies from about 60 degrees Celsius until 92 is the highest one.
So it's pretty aggressive fluid if even at those low temperatures you're cutting through the casing.
Yeah, it is. So yeah.
Okay, and what surprises me now you say that, because you're saying a lot of these wells were repurposed from Shell's development programs.
No, the repurpose, that's where we are talking about now.
Oh,
these dry wells or empty well or wells which were not successful when drilled can be transferred to geothermal. But no, actually, it is the data we have.
Yeah. Because
we have all these data of 1,000 wells in just a small country compared to, let's say, the UK or Germany. So yeah.
Okay. So if I look at I mean, your job is much broader than geothermal, isn't it? I mean, you said you covered almost every renewable sector in some way I hadn't even heard of.
That's right. So, yeah.
So when you're putting your board paper together, how does it differ for a geothermal project to your board than, say, I don't know, one of the other renewable energy sources?
Well, there are three main topics. The first one is that you're working subsurface. So you are working on, let's say, P50 models and P90 models of the expected energy deep down below. And from a bank perspective, we were used to a P50 and a P90 in wind and solar, but these probabilities were measured sometimes from years before the project started. And yeah, subsurface, there's no ability to first test what the energy capacities are down there. So the drilling is also, the proof of the pudding. Let's put it like that way. There is no test drill possible because it's a very expensive technique to drill. So that's a very important issue. You never know what the megawatts are deep down there compared to wind and solar. Another issue is...
Sorry, Ivan, I can understand why it's... but this is the same as oil and gas, isn't it? I mean, basically, we drill the wells, we drill exploration wells, we drill appraisal wells, and we do well tests and we log them, and we calculate a range of potential deliverabilities, oil and gas in place, recoverable reserves from those. So presumably, despite what you said, you're not at the very end, the exploration side of this business, are you? I mean, presumably the delineation has been done before people call you up and say, "Can I have some money, please?"
Well, we are called before the drilling starts off.
Really?
Yeah, yeah.
Okay.
So we also share in the risks during drilling. Sometimes there's enough equity until the first well tests, but there are some examples where we already are financing during drilling of the first well, and we can only do that because of our governmental insurance product, which takes out the insurance of reaching or not reaching a P90 scenario.
That's really interesting.
Yeah. And another difference from solar and wind is that direct use is involved in heat, and instead of electricity, heat cannot be placed on a national grid. So you always have to look very nearby where you can, let's say, sell the heat, and that's so it's also more complex than the conventional techniques like solar and wind. And the last topic in my top 3 is permitting side. Permits take a long time and a lot of stakeholders, so it really takes years before you can order a drilling rig on site.
So from the equity perspective, presumably you've got equity partners, then you're saying to the equity people, sorry guys, you're going to have to wait some years before we're even going to start production, simply because of permitting?
Yes, permitting is the most important time issue in the whole setup, indeed.
Is that just the Netherlands? What is that? Who anyone else got any? Hello,
It's
I've got
everywhere.
a shaking of the hand from Elin.
It's everywhere. Permitting, legal, regulatory framework. It's always, I would say that is one of the biggest barriers.
That's crazy.
Yeah, and it's more difficult since Tim, you started off saying that compared to oil and gas, the value of hot water is nowhere compared to the value of oil and gas, of course. So that's also an important risk factor, of course.
Yeah, that's right. You don't have any room to maneuver because ultimately there's so little value in the product that if you get it wrong, then And how long do you then? Sorry, someone I didn't. Sorry.
I was just going to jump in. I mean, that brings up another interesting distinction between geothermal and solar and wind, where the resource risk for solar and wind is much less than you have in geothermal. But ultimately, the product here is power, and or hot water is a distinction to oil and gas, where there's a lot of value in the commodity. Most equity or developers make the return in contracted solar and wind projects through the use of leverage, but because of the resource risk inherent to geothermal, debt capitalization supported by those projects is less. So it's an interesting dynamic that comes into play.
Are you? Can I just tease that out? Are you saying that the amount of debt that a project can sustain is considerably less?
It's less for two primary reasons. One is the resource risk that we've been discussing. I mean, solar now is pretty highly predictable. Wind generally considered to be less predictable than solar, but also more predictable than geothermal. With geothermal, you introduce the risk that you could have a seismic shift underground that kind of cuts things off and sustained underperformance, and that risk is considerably higher than in a solar project, for instance. The other way that comes into play is renewables are generally financed based on contracted cash flows under a PPA. So the PPA off-taker may not want to sign up for, or the project may not want to sign up to a PPA that is at the full capacity of power that the project is capable of producing because of volatility. And so you may have uncontracted cash flows that are not able to support as much leverage than if it had been fully contracted under a PPA.
Yeah, and that's
it's also a timing thing, Tim. The ability to get debt into the structure. You can get it in right very early on wind and solar projects. But of course, with geothermal, you've got a lot of equity is needed to finance the resource development. And without, that's a high cost of capital that is purely used, and you can't bring in debt until you've got the proven resource and the license to extract it and the PPA, and all that stuff has to be equity financed currently. And even the equity finance is kind of unattractive because there is always that low probability, high impact risk of coming up with nothing.
Yeah.
On the subject of which then, can I just ask about Ivan, would it be too rude a question to ask what a typical coupon is for your debt piece, and then for someone else to say what typically would the equity want in terms of equity return? Ivan, if it's commercial information, don't tell me, but I'm just wondering whether you can give us a steer on it.
Well, since the capital markets interest is quite low at the moment, for debt, I'm at this moment, I think you are in a range of, let's say, 250 basis points until 350 basis points for, let's say, a 10-year fixed interest. Yeah.
Right. Okay. And
so
what about
quite low, I guess, for now. Yeah.
Really, I mean, you'd be lucky to get that on a reserves-based loan for an oil and gas piece. What about the equity? Can anybody pitch in without divulging any confidentialities what the kind of equity returns people are demanding in this industry are?
I would guess looking, high 20s, 30%.
So unlevered equity, levered equity returns of high 20s. Is there any kind of agreement on that? Is that the kind of number that anyone else? That seems pretty chunky. Anyone else? Yeah.
Well, maybe indirectly, because our government is very afraid to provide state aid, so to cross the international regulations regarding giving too much aid to companies. And in that mechanism, all kind of theoretical financial models about kind of say example projects, all kind of assumptions where you can discuss for months. But in these models is a kind of a minimum equity return, 15 until 18%. But I more agree to Julian, that's really not sufficient for this technology. So more in the 20s or 30s. Okay. You need to counterbalance for the risks that are there.
But did you mean by that 15 to 18 a min and a max? Are they trying to
it's a kind of range, range depending on the type of standard product they define.
Okay.
Project.
Let me park that. I know there's so many things coming out. I just want to bring other people in formally. So Katie, I don't know, ask a question of you. So what types of risks are the project lenders willing to take, and what would you say fall under developer equity risks?
Yeah, so I would kind of bucket it into the two, and then maybe potentially a bucket of risks that nobody is willing to take. But I would think that the developer is responsible for field studies, drilling in the field, doing test bores, and getting a good idea of the flow rate and the temperature. And some of that work may have already been done by governments who have done field studies, which can be leveraged as well. Generally contractors won't take those risks, but they'll come in once the resource is known. So that's kind of phase one. Banks would come in at a later stage once, after a contractor is willing to come in, after an offtake contract and an EPC is in place. Lenders are going to want to have the project to have, permits, land entitlements, resource reports from someone credible for the engineering, and they'll look to run sensitivities, and they'll want to have a high-level estimate for the cost and the energy potential. So, kind of long-winded way of saying, banks will come in at a late-stage development or pre-construction type of stage for the financing.
Isn't it interesting that you're definitely talking from a private sector perspective, but Ivan, I think you were saying something unusual, which obviously was being supported by your government, that you'll come in earlier.
Yes, there's a governmental insurance product because the commercial insurances are, as we believe, are not happy to pick it up. Is a product where for a premium of 7% of the expected drilling costs, you can take out an insurance where you are insured for not reaching the P90 in the reservoir.
Yeah.
And there is your own risk is then 15% of these drilling costs. So you also always have an own equity risk. Above that, the 50% you can insure until the P90 not being reached for 7% premium.
So your government, to be specific, has decided that a way of opening up this sector is to de-risk the front end by providing, so extraordinarily, in my experience anyway, for banks to come in as early as that, especially when you're only seeing 3.5% coupons, and therefore you're not covered if you lose money in a loan. Interest. Okay.
So one of the challenges when the private sector evaluates, government incentives, and in the U.S., if you look at what is there for solar and solar, wind, other renewables, if you have renewable energy credits, SRECs, RECs, LCFS, RINs, things of that nature.
Katie, you'll need to spell them out because we're not all.
Low carbon fuel standards. SRECs are solar renewable energy credits. So these are credits that have a floating. They have a floating price, and so banks, and if you were trying to get a deal rated, these are incentive programs, and now depending on the type of incentive and the tenor of the ultimate financing, there can be a lot of questions around, are these incentives going to last through different political regimes? Are they going to last? If you have a financing and a PPA that is 20 years long, people will do a lot of run a lot of sensitivities on the values of those, particularly at the curve, because it can be a large question mark about whether those things are going to endure over time, particularly as more renewables come online.
That's a pretty crucial risk, isn't it? I mean, if you can't trust the government to keep its word for a long enough period to allow the thing to become sustainable, then they're almost like they're putting a barrier up.
I think it's a little bit more nuanced than that, actually, Tim. But we get a lot of inquiries to actually underwrite that change in regulation. It's an important but subtle distinction between political risk. It is policy risk. Governments only put in policies for 4 or 5 years at a time. They don't want to put in a policy mechanism that's there forever, or even if they do put it in forever, there's nothing to stop a future government coming in and changing that. Yeah. So it doesn't matter what they legislate today, there is always that policy and that regulatory risk. And again, that's something that we've been asked to look at a lot in the insurance industry, where we've developed the specific solutions for these. They're very bespoke, they're not easy to do, but it is an important part of that financing mechanism.
I think actually, Julian, maybe I should ask you anyway, what risks can the insurance industry take to try and roll out these projects, or help them roll out better?
Well, the one we've been focusing on for some time now is that resource development risk. We did a study well over 10 years ago on behalf of the World Bank to look at the risk profile at different stages of the project's development. And the one that is most unique to geothermal is that resource development. So what we've done at Parhelion, what we promoted to the World Bank, and then continuing to develop in the private sector, and indeed working with other sort of multilaterals like the Green Climate Fund and others, is to put in these insurance schemes that puts a floor on the downside for the equity investors. So Ivan's already referenced a government scheme in the Netherlands, and there have been other government schemes, in France and elsewhere that have looked to address that. But the insurance industry is, it's a $2 trillion pool of capital that can be mobilized. And if Ivan's talking about a 7% premium rate, that looks pretty good to me. I'm not sure you actually need a government to be writing that. You should be mobilizing the private sector capital, and it's interesting to say, what is the role of that public sector capital, and how can we mobilize the private sector? So maybe where the project developers are faced with, do we get debt? Do we get equity? Do we buy the insurance? Perhaps one of the roles is for the governments to make a premium finance mechanism available, rather than taking the risk on their own government balance sheet. Why would they want to do that? They can lend the money to the projects to buy the insurance. And that becomes a very efficient way of using public funds to mobilize private sector to support this industry.
I get it.
Yeah, and let's just look at the reason why it's an insurance type risk rather than an equity type risk. It's because once you're looking at that resource development, understanding, as you say, the upside downside is very different to an oil and gas project, but there is always that low probability, high impact risk that you could undertake your drilling program and come up with nothing. Now, that low probability, high impact risk is fundamentally unattractive even to equity investors, because to an equity investor, breaking even is really a failure. The risk of capital impairment is fundamentally unattractive and enough to walk away from. But low probability, high impact, that's the kind of risk that the insurance industry takes. And so using insurance capital to underwrite or put a floor on the downside from a drilling program changes the risk profile for the equity investor. It means they have that known downside. It reduces the risk of that capital impairment. And it uses the right capital to take the right risks.
I've got when you talk, this sounds to me like the equivalent of maybe a large oil and gas company looking at, say, 20 exploration prospects. Now, they wouldn't go to an insurance broker or an insurance company in the first instance. They simply say, okay, we will farm out part of these, the working interest in these 20 prospects. We'll drill them all, or we'll drill most of them, and we'll rely on our sophisticated subsurface understanding to work out geological chances of success and the P90, P10 spread of potential resources. Now, so this does pick up on a point that I discussed with Katie, which is whether the type of institution that's developing the geothermal project influences how it's financed. I mean, Katie, can you speak to that?
Yeah, sure. I mean, a lot of, if you look at solar and wind projects, usually frequently the developers, don't have the capital resources to develop these projects on balance sheet. And so really many developers, get the project to FNTP or to kind of a pre-construction stage and then sell it. Large oil and gas companies may have the resources to, and the skills, as you say, to, they may have the subsurface geotech skills to evaluate that risk and be more comfortable with it. And then they might be able to, fund development, or even, they wanted to be the final, equity owner, they might have the resources to do that on balance sheet. And that's not something that is commonly seen in solar and wind, though changing a little bit now that larger corporations are interested in, building and owning and developing large solar and wind projects.
Can I understand? So are any of the big any of the majors actually doing what we're saying, which is looking at a significant number of geothermal projects and saying, okay, this is just a different category of exploration project to us. The exploration department can handle it, and we will allocate capital in the normal way.
So there, I think you run into the challenge that we were talking to, where you kind of have mismatched, you don't have the same equity upside as for a geothermal project as you have for an oil and gas type of project. And what Julian was talking about too, you could effectively use an insurance product to make the equity investment look more like debt, where you're protecting your downside there, which is kind of an interesting way to look at it. Yeah,
it's a de-risking equity, yeah.
But I think also, there is a gap. I see always a gap. Like most of the facilities that are out there to de-risk are for exploration drilling, which is not for all of them. But then many of the private investors, they have difficulty to finance the remaining drilling, and many of the financing institutes, they are requiring that you have already drilled 110-20% of your steam or energy available before you can get some financing. I mean, where does the de-risking end, and where does the private sector take in? I mean, it's very important of them for the government to know if they are doing a de-risking. How far should they go before the private sector is willing to come in and do the remaining? And so that's I would be very interested to know that.
You heard before what people are saying. I mean, I think Julian said that I can't remember who it was now, said that they were thinking of equity returns in the 20s or even the high 20s. Now, I finance oil and gas projects at 22% typically unlevered equity return. So
I am sorry, I've never heard of a geothermal project that delivers so much equity. So
well, then maybe you answered your own question, which is that unless we can get you said at what point did the private sector take in? Well, if it's not profitable enough, let's go do something else. I mean, real estate, you can get 20% rate of return easily enough. So so you're saying, well, we're back to saying, well, we've got this project which isn't very profitable, and we know the huge global benefits of rolling it out as a baseload power supply. What is it we can do to magic to a sustainable private sector development here? And the answer might be none, but that is the whole essence of this. Is it's not profitable enough. And so,
well, it's about the cost of capital, Tim. If you have to finance everything through equity right up until you can get to the project finance bit of building the topside plant, that's a challenge. But if you can reduce that cost of capital by using insurance to make it more debt-like, or even bring in debt, as Ivan is able to bring in debt to his project because he can rely on a government insurance scheme. If we would certainly expect to see, with the use of our insurance mechanism, it makes it easier for equity to come in, but it certainly would enable debt to come in at that point. And that is a huge changer for the cost of capital.
Absolutely. So can I ask both Ivan and Katie, what proportion of the, if you like, the construction cost after the delineation phase, what proportion of that would you fund?
I mean, I think it really depends on the PPA and revenue framework. So the way we would think about it is very similar to other types of power projects, but with a higher DSCR to account for the additional resource risk here. So as opposed to thinking, well, the whole entire project costs $100, and so therefore I will fund 75 or 80% of it. It really depends on what is your contracted cash flow over time, what's the duration of your contract, and what's the applicable DSCR that the lender thinks is reasonable to apply there. So that could end up ranging as opposed to just a percentage of total capital cost.
So would you be using loan life cover ratios and field life cover ratios in the same way that you would in oil and gas projects?
Yeah, more similar. Yeah, so similar to oil and gas, and also similar to solar and wind, but the debt service coverage ratio, or which is the credit metric that we most commonly look at and use, would vary depending on the resource risk of the asset.
Okay. And so, Ivan, is it different now? You've got, if you like, some government support. I mean, can you stretch the envelope a bit more, or are you as rigorously linked to?
For us, it's about the same as Catherine explains. Yeah. But you shouldn't take our government insurance too seriously, because only the reservoir until a P90 model appears to be insured. So all risks during operations are not insured by this mechanism. It's just whether the drilling bit hits a reservoir P90 heat or not. Yeah. That's really what it is about. But talking about depth sizing in our country, direct use, we need 15 years PPAs, so 10 or 15 years. Also, our subsidy scheme per megawatt hour is based on a 15-year subsidy tenor. and typically our leverages are at 30 until 40% equity. So 30-70 is the leverage to 40-60. That's about the range geothermal projects are. Whereas, for example, in wind and solar, it's about 10-90. So
why is that?
The leverage, well, because solar and wind are much more stable, more predictive. You've got all kinds of product guarantees, and geothermal you have less or none on that side. So we, from a bank perspective, need to have a more comfortable leverage, and also higher DSCR ratios are needed compared to solar and wind, much higher.
Is that depending on location? Like in Dominica, after the hurricane, they at least evaluated that geothermal would be a good resource because it was more stable towards climate change and climate and weather conditions. So is it universal, or does it matter where you are located?
Well, when it works, it is a perfect baseload technology. But like I explained in the beginning, corrosion, erosion, other issues arise during operations, which make that we need to provide extra depth for workovers, for repairs. And in solar and wind, we hardly see them. You finance the entire project at the start, but you hardly have to refinance or restructure or provide extra depth during the operations of a project during the tenure of our loan.
Okay.
So
I mean,
we are very happy
also...
that we have very high standards on DSCR ratios and leverage. Yeah, because sorry.
I think it's I'm saying it's very common to say. I mean, in Holland you have the same resource as in France, but I mean, even between wells within the same field, you can have the difference.
Yeah.
Corrosion factor. So I mean, you need to do your homework, and like Julian, I think mentioned in the beginning, like the GRMF has made sure that at least some initial work is done properly, so that people are coming a little bit more prepared when they are seeking finance and seeking insurance. So I think that is a key factor in everything.
We've got only regrettably 12 to 15 minutes left, and I'm scanning down a list of questions that our audience have provided for us. But while I'm scanning down that list, can I ask you please to debate this issue of standards, because all of you say things like our opinion of P90 or our opinion of the subsurface risk of delineation, and I'm wondering who are you relying on, or what standards are you relying upon to opine as to whether this particular project is P90 or P50? So while I read through these questions, could one of you pitch in and the others come in after that?
I think, I mean, United Nations certificate.
Right,
yeah. They have made a standard that should be applied to compare all renewable energy, and they have incorporated geothermal into that. I think that would. Sorry.
Who is using it?
Not many, I think, but it is increasing. It is becoming a requirement in projects.
Ah, right, that does it. So you're saying the World Bank will, when you're talking about your list of how do you make a project ready for the board, you need to have some sort of a resource standard applied to the heat resource or the power resource. Is that what you're saying?
Currently, it's not a requirement, but it is increasing in the project that it is done by that. Also by financier to require that it's done, but it's not widely used yet. But hopefully, at least it would provide some kind of standard throughout the industry.
I love it. I mean, it's based on PRMS 2007. What about Ivan and Katie and Julia? What are you using? Are you using the United Nations standard or something else?
And then we have. Sorry, Julian, go ahead, please.
Go ahead, Ivan. Go ahead.
We're not. We work with the clients, and so long as we agree it in advance, we can be flexible. It's not our role to set standards, but it is important to know what you're working to. Right?
In the Netherlands, we've got a software provided by, I think, liaised to the government. It's called Doublet Calc, and that might, I don't know whether it is, but I can imagine that it taps in on the United Nations standard maybe. But it's a quite common software product, and also the government who decides on the granting of the subsidies per megawatt hour. They use the same tool with their own geologists, so they assess the expected P90, and then very often we have a third assessor who again looks at a P90 model, and so you get some kind of a common ground what the expected P90 would be. Yeah.
Okay, Katie, what about Goldman Sachs?
So, I mean, banks, bankers are typically not engineers. I mean, they may have engineering degrees in a past life, but generally banks, banks that are lending, or if you were to issue a bond, the bond investors would really rely on the independent engineers report, which would be part of a critical piece of the diligence package. And the independent engineer will have a software program or a way of looking at P50, P90. But I think that as the World Bank or multilaterals, if they start adopting UN 2016 as a standard, I think that the broader market will start to coalesce around that as a way to look at this.
Okay, we're not there yet, but there's a clear feeling that this is the logical and right thing to do, is to have a common standard, or maybe more than one. Look at and reading out some of these questions we've got from our audience. Here's one for anybody. What about co-production projects, hydrocarbons and geothermal energy, or geothermal and CCUS, or geothermal and lithium? Has anybody got any experience of that, or you've not experienced any opinions on trying to fund these co-projects?
I think one interesting thing, and I'll pick the last one of those mentioned as the example, geothermal and lithium. Yeah. You introduce project on project risk if you're going to use the geothermal project to power something else, or you're going to use the geothermal project for some other purpose. I think that in that way it makes it even more complicated than what we've been discussing here. So interesting question that was posed.
But it will add revenue streams to the developers. Would that not have a positive impact?
Well, if you think about how if you're using the geothermal project to power like an associated lithium project as a debt provider, you're exposed to the performance of that second project as opposed to just selling the power to a utility.
No, Sorry, they're not talking about using the geothermal power for the lithium. They're talking about extracting lithium from the geothermal fluids. So you could buy the power plant, and then you have the residual fluids that are coming out of the power plant that you could extract other uses like lithium extraction or greenhouses or other. So you have a combined heat and power plant, so to say, or combined power and lithium extraction plant.
Your lithium extraction project still needs to generate revenue somehow, versus which is inherently more complicated than if you had a utility offtake that has an A credit rating, which is easier for banks to diligence.
Okay.
So sorry, Julian, you go ahead.
Well, I think some of these dual use projects may be really interesting to look at in some of the emerging markets where there's high energy, high entropy projects, in the East African Rift Valley in Kenya, particularly, combining it to make green hydrogen. I mean, Katie does make an important point. It is sort of adding project risks. You've got to make the geothermal project work and the hydrogen solution work. But that is something we as a sector need to be able to deal with, that complexity. And find ways to bring in these additional revenue streams, and I think as we see more government engagement in the international action on climate change at Paris, is there, is the Paris Accord going to be able to create a market where you can get properly compensated for creating green hydrogen from geothermal projects and allow Kenya to meet its climate change commitments and so on. I think that'll be really interesting to explore.
But I would also be interested in, there has also been talk about industrial parks. So you have either the power plant or you have the power from the grid, and you utilize the heat for industrial parks. So you have various revenue streams for your geothermal utilization. You can have a dairy farm, you can have, or you can have a spa or a greenhouse, or all of these different revenue streams. Are you saying that would be more difficult to finance than a normal project where you would have, you usually also have more simple, when you have a direct use, you have more simple above ground equipment than for power plants. So are you saying it would be more difficult because you have more revenue streams, or is it equally difficult to finance?
It is more difficult at first, in the first years, until there are sufficient projects who have proven themselves, because you have all kinds of changes in these revenue streams. And I don't know, but in the Netherlands, I'm not a chemist, but we have experienced that just from releasing the CO2 from depressurizing, the fluids change. So the specs of the fluids change, which led to problems in the injection side. All kind of crystallization of other substances, bacteria, clogging. So I don't know what the extraction of lithium, be it that it is very interesting. I sometimes read about in England is going on, I think in the Alsace. So very interesting developments, but at first, in order on the financing side, I think it's more difficult in the beginning. Yeah.
Okay. I'm really sorry. We've just been given a 5-minute note, if you like, to say we've got to wrap up. Although I am always tempted, anybody who knows me, in running over and over. But let's try and keep roughly to time. And so what I'd like you to do, if you wouldn't mind each, is to spend a minute or so on the kind of thoughts you want to leave this audience of everybody from government officials to small companies trying to develop their first project. Just try and think of some remarks you want to make. I don't know, Elin, you start, and then Ivan, if you fancy, or if it doesn't come to your mind, anybody pitch in and start and say something, and let's just gently wrap it up. Really regrettably, but who wants to say something about just a kind of ending piece?
Well, I'll say something. We've identified some challenges for the industry, and yes, it's not easy, but we have some really important sustainable development goals that we need to deliver, and one of those SDGs is number 17. It's partnerships, and I think geothermal industry has to work on those partnerships, across the multilaterals, the debt providers, the equity providers, the insurance industry, the engineers, the oil and gas sector, bringing their expertise to the industry. And partnerships are going to be key, and it's getting that capital structure right, and the business model right. So, yes, Kenny makes a good point about, project risk on project risk is not necessarily attractive, but there's got to be ways to do that, and we have to have a longer term vision as an industry to make it work, and recognize the sustainable development benefits geothermal can deliver, particularly in these emerging market territories. As I say, we've done a lot of work in East Africa. We'd love to see the geothermal sector expand there, and it's an opportunity for those countries to start building out other technologies and other products and exports, rather than importing fossil fuels. Maybe they can start exporting hydrogen and start becoming, powerhouses in that economy.
Brilliant. Anyone else want to say anything?
I want to say here. So nothing to add really, to Julian. Thank you.
Yeah, maybe I would like to. I found it really interesting discussions, and I think there is no one solution fits all, and there is no one renewable energy source that will solve all of the problems or all of the energy we need to, get to renewable in the future. So I mean, we will need all of the renewable energy technology we have, and so I think it is I think that it's been very interesting. Thank you.
Katie, do you want the last word?
Tim, I think it's been well covered by everybody else. But yeah, I think energy transition and renewable energy is on topic worldwide on everyone's mind. So glad that we could all come together here to discuss some potential solutions.
Yeah. I thank you guys so much. It's been really interesting getting to know you, and I know this relationship will go on afterwards. I'm waiting for the first $1 billion geothermal project, and then I kind of know that once we can get to oil and gas type scales, that we will be able to roll this thing out and finally put a proper argument against the IEA's policy documents where they really didn't see much of a future for geothermal in 2050. But I just have to thank you all very much indeed for educating me and a fascinating discourse, and I hope this relationship continues into the years ahead. And I thank Touchcast for ably managing us all and the time. And I guess with that, I should ask our audience to wait on for the next session, and to thank you all very much for your attention. And with that, I wish you all good night from the UK, and I'm sure good afternoon from other parts of the world.
Thank you.
Thank you all.